Robschild, thanks for tuning in. No investment advice. Welcome to the show where we view financial markets through crystal ball gazing. JP Morgan once said millionaires don't need astrologers, but billionaires do, and so we begin. Today is Wednesday, August 21st, 2024. Notably, we had the Fed minutes come out, and maybe even more notably, the BLS Revision came out, thanks to a commenter for alerting this to me. I usually look at what's coming up from Market Watch, and this was not in there, but it came out today, became kind of a headline. BLS Revision from April 2023 through to March 2024, they revised the job creation number down 818,000, which is pretty substantial. But I'm not really surprised here. If you've been watching this show, I'm expecting weakness here. Everything's expecting weakness here. The way I kind of see it is the market has been climbing way higher than it should have ever gone. It's standing on the edge of the cliff, looking down with wind blowing on its back. Mr. Market has lost his mind, in my opinion. And yeah, so the data being revised lower, the data from all sorts of places seemingly to come in weaker than analysts are expecting. And, this leads into the next point here from the Fed minutes. They were considering actually a July cut, and that was kind of another big headline. And so, yeah, they're scared. This is the point where the market slows down, where the economy slows down. The reason for these cuts is not because the economy is doing well. The reason for the cuts is because they're scared of how much it's going to slow down. Remember, we're not down to the 2% inflation target rate by their own metrics, but they're cutting already. What does that say? It says that the Federal Reserve, which has like infinite resources seemingly, as far as economic models and these things go, they're scared right now. Considering a July cut, July has passed by now. And off of all of this news, by the way, we had November flip back to a double cut before it, it's flopping back and forth a little bit here. But, this is, again, and then moving forward, we're expecting an orderly, okay, right now it's one cut, then two cuts, then single cuts every month here on out. But, when I look into my crystal ball here very deeply, as every cutting cycle kind of plays out, the market kind of always does this. They expect, single cuts for it to be very orderly. But what ends up happening is the cuts start getting closer and closer, the opposite of what was happening before, where the cuts were getting further and further away. Goldman Sachs has an analyst that came out that my comment on his comment was weird flex, but okay. We're going to go over to a quote from investing.com, quoting an analyst at Goldman Sachs. Since the QCEW, quarterly census of employment and wages, is based on unemployment insurance records, it likely largely excludes unauthorized immigrants who we believe have contributed strongly to employment growth over the last couple of years. The reason I say weird flex okay is because does this guy live in a box that he doesn't have access to the outside world? So everything's okay because we have undocumented immigrants pouring into the country, filling in employment spots. This is what's saving the economy right now, and so everything's fine. I don't know. Weird flex, but okay. S&P 500 went up today. We're very close to all-time highs, but very, very notably, this is on very light volume, suggesting it's retailers doing this. And This is not a move to trust. It is an untrustworthy move. Not to say that the market could not possibly go higher. Yes, it can. It has the possibility to go higher. But watch out big time here. Last thing from my notes from the beginning. The oil chart. Yesterday's oil chart was actually DXY. I'll show you the real oil chart here. Alright, here it is, the real oil USD chart from TradingView. As you can see, we've been heading lower and lower, notably very recently, really going down, all while exactly at the same time the S&P 500 is going exactly the opposite direction for about maybe a week and a half. And when you have that kind of direction, especially on a short-term time horizon, the jaws will shut. The S&P 500 going up, the oil going down. Will oil go up, or will the S&P 500 going down? It's not very hard to see how this will likely play out because of the fact that, you know, your retail investor is not trading oil. These are professionals. These are institutions that are selling, that are having the oil prices go down. And it's the retailers that are having the S&P 500 going up. And so it's, in my crystal ball, it is extremely crystal clear that it is the retailers that are wrong, and we should be seeing significant weakness ahead. Zooming out to a perspective that goes back to where my mouse is right now, the beginning of 2022, you can see oil has been not going up and up and up and up like the S&P 500. So also on a longer time horizon, oil has cooled off, has been pretty much flat. And the longer any market goes flat, the more buildup there is for a breakout, whether it's to the upside or to the downside. My crystal ball says we are headed lower. Before we jump through the rest of the charts, I just want to once again remind everybody, this is our daily reminders, the 2-year, 10-year yield curve inversion is well past its second birthday. I believe this has never happened before in history, suggesting a major recession or even depression coming, as the stock market just keeps going to new highs and just doesn't care and says, oh, you know, what could possibly go wrong? You know, everything's perfectly fine. This is what they were saying in 1929 before the Great Depression, just so you know. People never change. This will happen over and over again. You know, I feel like at this point it doesn't matter how much AI you put into everything, artificial intelligence or whatever. People make the same mistakes over and over and over again. Stocks are largely overvalued. There's a lot of overvalued, let's say, market cap of assets out there right now. Too much speculation. It's gonna blow up. That's how it's going to happen. No investment advice again. The other thing, SOM rule has been triggered. This is probably one of the main reasons the Fed is looking so scared here as well. When this triggers, it typically says that yes, we are currently in a recession. Notably, again, unemployment is not super high at 4.3%. I think was the last number of this. But the rate that it's been climbing higher is concerning, and that's what triggered the SOM rule. Taking a look at the S&P 500, as you can see, we had another green day. We are just a stone throw away from breaking all-time highs again, but we are on ultra light volume, suggesting that this, you know, I still am in the camp of seeing this roll over down to the downside and forming a head and shoulders here. Maybe being the final top of the market, which would make a lot of sense since cuts start next month. As greedy as the S&P 500 seems just by looking at the chart, the Fear and Greed Index on CNN is also only in neutral right now, suggesting that we could go either way from here. Adding to the bearish side of the market, the VIX futures term structure. Again, this is not supposed to look this way. It's supposed to curve. Where's my tool? It's supposed to curve up like this because time costs money, right? You're not supposed to go up and then down. That doesn't really make any sense. So the market is pricing a lot of volatility coming very soon, specifically around October. I myself have puts on HYG. I doubled down on that position today with a small percentage of my portfolio that will gain a huge amount of value if things do play out the way that I see them coming in the near future. I'm not the only one scared of October. The whole market seems to be that way right now. Again, October has been elevated for a long time. Now this contract has been elevated for many months. So this isn't out of the blue. We were smelling this from pretty far away. Junk bonds, HYG for now. They don't not only not smell any fear, but they're just blissfully going higher here. People are willing to pay money for higher risk and lower yield for the amount of risk that they're taking. Again, I feel like we're looking off the side of a cliff here. I brought up a few days ago DXY kind of falling off here with the dollar dropping while gold was down a little bit and treasury bonds were going up, and I was like, I don't know why it's going down. So, the main thing with DXY is that it's compared to other world currencies probably more than gold, and so that's so it's falling. It's going down because of the expected cuts. As rates go down across the curve, borrowing gets cheaper of dollars, which weakens the dollar compared to other currencies. When you have tightening, so money is harder to borrow, is more expensive to borrow, then the dollar becomes more expensive relative to other currencies. And so when you have other currencies like the yen or whatever the currency is, when it's loosening monetary policy, it weakens the currency. When it tightens it strengthens the currency. So what we have going on here with the Fed cutting is that they're actually worried that the dollar's going to be too strong, and so, or is too strong. They want it to be weaker so that the economy doesn't fall apart. So on a very short-term time horizon anyway, the dollar's getting weaker here to other currencies. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching. See you next time. Robschild.